In this video, I've recruited the help of Marco Lorenzi, a fellow YouTuber, and we will be talking about the 5 things we wish we knew before we started investing our money into the stock market. Welcome back to my channel. My name is Euan, and on this channel we talk about personal finance and investing in the stock market. And today's video we'll be sharing what things we should have known before investing in the stock market and what we would have done differently to avoid these mistakes. So Marco and I also did a collab on his channel about how to save for a house. So go check that out after you finish with this video. And hello, Marco.
Hi guys, my name is Marco. I live in Hampshire and my channel is about investing and personal finance. I've got a trading 212 portfolio, but I also invest on free trade, and quite soon I'll be starting also on eToro. So come have a look at my channel if you want to boost your finances. I am super excited to be on Euan's channel today, so thank you, Euan.
So if you've been following this channel for a while, then you'll know that I love compound interest, and I'm going to go there again and talk about it again today because it is the key to sustainable wealth growth. I don't care if you made a load of money from day trading, forex trading or whatever. I don't think that is sustainable, but one thing that is sustainable is compounding interest, the compounding effect. So this can be used over a long period of time and you can make a lot of money. This is the thing that I'm trying to get into people's heads, is that the compounding effect is the main way of making a load of money by investing in the stock market. It does take a lot of time, however, it is the best way, in my opinion, to make a lot of money, and the main reason that Warren Buffett, for example, is one of the most wealthy investors.
Investing is a way of making money while you sleep, and an important part of your journey is to understand your financial goal. Are you investing to retire early, or perhaps to set up your own business, or maybe to buy a bouncy castle? If you have one, let us know in the comment section and I will be there in no time. But the bottom line being, whatever your goal is, you will get the best result if you give yourself a deadline. So as a rule of thumb, and if you want to stay invested for more than 5 years, then you should buy a lot of stocks and ETFs. But if, like me, you want to buy a house in 2022, then you should look for a quicker profit with investments you can swear by, like Tesla and crude oil.
So as you may or may not know, I use Trading 212 mainly for my investing because it is a fee-free platform, as long as you stay away from the CFD side of the app, because that'd be naughty, wouldn't it? So the broker Trading 212 is free of fees. However, some other companies will charge fees for you owning an account with that company or investing in some of their products. But you also have to factor in fees if you're buying into funds. Fees on funds are directly correlated with whether they are actively managed or passively managed. If you are investing in an actively managed fund, then you will be paying more because a company will be looking after the stocks and shares inside that fund and managing it for you. So they will take a small cut, which is usually around 0.1%, but it can be more. Passively managed funds tend to have an average of 0.2%, and surprisingly, the passive funds often outperform the actively managed funds. So that is something really important to consider.
If you had £1,000, would you make more money by investing the whole pot in one go, or by buying £100 worth every week? Well, it depends on your luck. If you go all in and the market drops like a stone, then you might see red for years, and it's not good. I've been there. But if instead you buy £100 this week and then the market drops, then you can buy again and get a better average price. So bottom line, cost averaging is a way of de-risking your investments.
This is one I've mentioned on the channel before. This is probably the most important one to avoid. Leverage is an investment strategy of using borrowed money, specifically the use of financial instruments or borrowed capital, to increase the potential return of an investment. Marco and I do not like this at all. We believe it is very unnecessary to take these risks and should be avoided at all costs. Investing already has a level of risk to it, but it can be reduced by investing for a long period of time. However, leverage allows you to use money that you do not have, aka debt, in order to try and make a lot more money. In my opinion, it's not worth taking the risk. One of the rules that Warren Buffett has for investing is don't borrow money to invest because it is stupid as Sorry, I added that last bit. But in summary, unless you're an expert in leverage and have some experience in doing so, then I would avoid it at all costs.
Well said, Euan. Leverage is a double-edged sword, so be careful out there. And thank you for having me on your channel. Let's do it again in the future.
So that's it from us. I just want to say thank you to Marco for coming over and doing this video with me. Please go check his channel out and check our other collaboration on how to save money. I really hope that you've enjoyed this video. If you have, please give it a like, drop a subscribe on both of our channels, and comment down below who you think we should collaborate with next. I'm also aiming for 10,000 subscribers by the end of the year, so please just tell your friends and make sure you are subscribed, because that's really nice. And we want to be friends, don't we? I'm not a millionaire, but I'm trying to help you become one. Peace! Be free. I hope you've enjoyed. It's an investment strategy of using borrowed money